How to borrow against Bitcoin safely. What are Bitcoin-backed loans? A Bitcoin-backed loan is a type of secured loan where you use your Bitcoin as collateral to borrow dollars from a lender. Instead of selling your Bitcoin to raise funds, you temporarily hand over your Bitcoin to the lender, who holds it until you repay the loan. Here's how it works in simple terms. You deposit a certain amount of Bitcoin with a lending platform. They determine how much you can borrow based on its value, and you agree to pay back the loan plus interest within a set time frame. If you make all your payments on time, you get your Bitcoin back at the end. If the value of your Bitcoin drops too much during the loan term or you miss interest payments, the lender may require you to add more collateral or risk having some or all of it sold to cover the loan. The key point is that you still legally own the Bitcoin while the loan is active. You're just not able to move or sell it until you've paid off what you owe. Why borrow against Bitcoin instead of selling? Borrowing against your Bitcoin holdings comes with risk and should only be considered if you fully understand the implications and have ruled out better alternatives. With that in mind, there are three main reasons why people choose to borrow against their Bitcoin. Maintain Bitcoin price exposure. By borrowing against your Bitcoin, you retain ownership and continue to participate in any potential price appreciation of your holdings, while still bearing the risk of price declines. Defer capital gains taxes. In the U.S., using Bitcoin as collateral for a loan is not considered a taxable event. Bitcoin-backed loans allow you to access funds without triggering capital gains taxes that would apply if you sold your holdings. Access immediate liquidity without selling. Bitcoin-backed loans are usually much quicker to obtain than traditional loans. As a result, they can provide fast access to cash without liquidating your position, enabling you to meet expenses, seize investment opportunities, or cover short-term needs while preserving long-term holdings. Leverage. Some borrowers use Bitcoin-backed loans to buy more Bitcoin as a form of leverage. While this can amplify gains if prices rise, it also magnifies losses if prices fall, making it a high-risk strategy. How Bitcoin-backed loans work. In this section, we'll explain how Bitcoin-backed loans work using a simple example. As we go, we'll introduce the key terms you need to understand. For example, a $60,000 Bitcoin-backed loan. In this scenario, the price of Bitcoin is $120,000, and the borrower deposits one Bitcoin, worth $120,000, as collateral. Bitcoin-backed loan terms. 10% APR, 50% LTV, 70% margin call, 80% liquidation. Loan details. $60,000 loan, 1 BTC at $120,000 collateral, current LTV 50%. Here are a few important starting terms to know. Interest rate. Most lenders quote interest rates on an annual basis, expressed as an annual percentage rate or APR. Interest payments can either be accrued on top of the existing loan or be paid by bank transfer, depending on the lender. Payments are usually made daily, weekly, or monthly. In this example, a 10% APR translates to about $500 in interest per month. Maturity. In lending, maturity refers to the date by which the loan must be fully repaid. Some loans come with a fixed maturity date, such as 6 months or 1 year, after which repayment is due. However, most Bitcoin-backed loans are open-ended, meaning they have no fixed maturity date. With an open-ended loan, you can repay at any time and keep the loan active as long as you continue making interest payments and maintain sufficient collateral. These loans do carry the risk that the lender may choose to close them at any time. If a lender does not specify a maturity date, it's generally safe to assume the loan is open-ended. Loan-to-value, LTV, ratio. The LTV ratio determines how much you can borrow relative to your collateral. It is calculated as the loan amount divided by the value of the collateral. In this case, the borrower has $120,000 worth of Bitcoin as collateral, and the lender requires a 50% LTV ratio. This means the borrower can take out a loan of up to $60,000. A higher starting LTV allows you to borrow more cash for the same amount of Bitcoin. Bar chart calculating 50% LTV ratio of his kits. Loan value $60,000 compared with $120,000 collateral. Ratio computed as 60/120. Please remember that nothing, and I mean nothing in this video, is financial advice in any shape or form. For the love of greatness, always do your own research. Money matters because your financial education is extremely important.